Good morning, or good afternoon, good evening, depending on where you're from. This is Kurt Frankenberg. I'm broadcasting live from Cody, Wyoming. I'm at my dad's house hanging out, and I'm joined, of course, by my good friend Mike Chupka, who's over on the East Coast. You're in where? Wilmington, Delaware? Is that
Yeah,
right?
yeah, just
Yeah.
a little bit shy of Wilmington, Delaware.
Very good. Okay. Let's see. And it looks like I was just taken out of the presenter dealie.
Oh,
Are you
that was,
seeing Are you seeing my screen anymore? Or?
no, I think the customers are now seeing my screen. You're still in attendance. Hold on 1 second. Let me transfer it back over to you. I did not do that. The system did it for us.
Ah,
You are now made the presenter again. You might want to try to pull up. I did see a little pop-up at the bottom of your screen that said it was having, there it goes, Mrs. Unable to connect, and now it's just disappeared. Now we're looking at your screen again. This is the About Kurt page, ladies and gentlemen, on the Radioactive Trading website.
that's right. Who's that handsome fella there? That must be me. Okay, Mike, we're going to get started. What I wanted to do is just open this up with a quick poll. And ladies and gentlemen, please understand that there's two reasons for the poll. One is so that Mike and I can get to know you a little bit and know how to guide the presentation, because we have some different things that we can go into. The other reason is that some of these polls are actually instructive. They're going to be the Socratic method of learning. So I highly recommend that you participate in each of the polls thoroughly. I'm going to launch this one right now. What's your involvement now with radioactive trading? Are you taking advantage of the free materials? For example, the sketch is available on the page that we're just looking at. Have you been checking out the YouTube videos? Perhaps the blog? Are you thinking about buying the blueprint? Do you maybe already own the blueprints and you're here to review the basics of radioactive trading and the setups?
And for the new people online, we might want to give just a little bit of background here. The sketch is a free white paper that you can access at radioactivetrading.com, which introduces Kurt's approach to trading. It gives away the best parts, we should say, of his trading methodology for free, and we're going to go over that today as well. But the blueprint is the whole 9 yards, the whole 10, 15 yards, I should say, really. It's the full description of what Kurt does, what he looks to get into, and all of the 10 different income methods that he uses on his positions. We're going to talk about that a little bit later, too. So just for those of you that weren't familiar with what's the difference between the sketch and the blueprint is the full boat, the large dinosaur there, and the sketch is just a little bit to wet your whistle, but it gives away the best parts for free.
That's right, and we're going to give away the best parts for free in today's webinar as well. Mike, can you see the results of that poll up there? I see 61% are taking advantage of the free materials.
That's right.
57% are thinking about buying the blueprint. 9% already own the blueprint. And, of course, that adds up to more than 100% because you could answer more than one
That's right.
of those. So, okay, good. 57% thinking about buying the blueprint. 9% already own it, and that's marvelous. Mike, I'm going to go ahead and hide that and give just a brief introduction of myself, and I'd like for you to introduce yourself as well. And all right, there's my screen. Okay, my name's Kurt Frankenberg. I own a martial arts studio, and I have since I was 18 years old. I got started trading the stock market in late 1998. And I promptly got hurt. In fact, I did make some money for a little while, and that made me cocky. And I wasn't taught about risk. I didn't understand about how to limit risk. And because of that, and because of the bad habits that I formed by being successful while doing the wrong things, Mike, I got almost completely cleaned out. This was back in 1998. Afterwards, I decided that, geez, my money went somewhere. It didn't just evaporate on me. There's somebody on the other end of that trade that collected it. And I figured that, geez, maybe I would like to find out what kinds of things the professionals are doing, and began a search and began to copy the great traders in the world. The ones whose biographies were available and whose strategies were available. And I saw a lot of snake oil. I got through a lot of false things, and I also Mike had the opportunity to learn what common things the best and most successful traders in the world were doing,
Mm-hmm.
and they all revolved around something that I write about in the book, the Blueprint, and it's something that I'm going to say is the holy grail of trading. Mike, let's learn a little bit about you. Okay, where you're from and what you're about.
All right. Well, I'm the Director of Education here at Power Options, and Power Options has been in business for 12 years. I've had the great pleasure of working with Ernie Zarenner, the founder of Power Options, and Greg Zarenner for the past 7 years. As I mentioned, it's a suite of tools for self-directed options investors. We support over 23 strategies. My main job over the last 7 years is to help investors learn the tools on Power Options, discuss strategy, give them direction, teach them options even from the very basics to the most advanced. I'm not going to be so arrogant to say that I've done it all and I've seen it all, but I have seen a lot in the past 7 years, talking to 30 to 40 customers a day, analyzing trades, answering emails about trade positions and management techniques. I can't give direct advice. But especially in this market, I feel that's very important, because the reason why I'm here with Kurt and the reason why I'm in the position that I'm in handling the coaching sessions is because I am versed in all 23 strategies on Power Options. And about 2 years ago, after I've played with covered calls, naked puts, calendar call spreads, straddles and strangles, different positions, traded in my own account, I came across a customer who was using our backtesting tools, and he was trying to identify married put positions using the historical suite of tools where the put was far out in time and deep in the money. And my response was, well, that doesn't make any sense what you're doing. You're not going to make any money unless the stock goes up 20 or 25%. Of course, the customer said, oh, really? Why don't you join me tomorrow afternoon for my presentation? I'll show you how I trade. Of course, that customer was Kurt, and I was so impressed by his approach and his techniques that I invited Ernie to join me for the next 2 presentations that Kurt taught. And then we decided to partner up with Kurt and enhance our married put techniques, patented search tools, and our analysis tools in the portfolio to coincide and to work hand in hand with Kurt's unique trading methodology. And the real reason why I'm here, why I joined Kurt on these webinars, is not only because I know the method, it's because I've been trading the method in my account for about 2 years. I also trade some standard collars, but I rarely do the calendar spreads anymore. I rarely do credit spreads anymore in my personal account. Most of my trades right now, in fact, all of my trades right now, are either a radioactive profit machine or a standard collar, which goes along with some of the same concepts. It's not exactly what Kurt teaches, but at least I am limiting my risk. And I think that's very important. And we saw part of the reason why a few days ago, and we're going to talk about that today too as well.
Yes, we will. What happened on Thursday there, Mike?
Well, there was several different reports going out, and I saw some different interviews today with that guy whose name I'm not going to be able to pronounce. I think it was ironic, right? It was a guy named potentially Nemel Timmel, I believe, who wrote a book on the Black Swan event, and it was actually his hedge fund that was putting in a very large order for about $75 million on 50,000 option contracts. That didn't cause the problem, but they're looking at it now where it might have been part of the problem. As the market was already falling and this order came in, other hedge funds had to change their orders to lock in protection so they wouldn't lose money, and just down, down, down. And as a result, now the SEC came out and said they've put in their, what do you want to call them, their circuit breakers, I guess is the term they're using for those now, to protect against this event again. And meanwhile, some of the other heads of the SEC, CBOE, and other organizations are on Capitol Hill right now, kind of talking to Congress, maybe playing a little bit of the blame game, but we don't know.
I wonder if out of our audience, I didn't load this into the polls, but I wonder if anyone that is attending today, if anybody got hurt. For example, you got stopped out of a stock, and that stock maybe came back, or you could have gotten a better fill if you'd just had a little more control over the process. I wonder if anybody got hurt. Could we hear from? Gosh, we got a whole lot of folks out there. We got 43 in attendance right now, and I'm sure that probably somebody had a bad experience with that. And we don't want to embarrass you or anything like that. We'd just like to see, hey, what can we do about this? And I never have to deal with problems with stop orders, Mike. Do you?
No, I did not have to worry about anything. I was actually on the phone during a coaching session with a customer when this started to happen, and he said, "Wow, are you seeing what's going on?" And I said, "No." And he said, "Well, the market's just going wild." And I said, "Oh, okay." I said, "Well, don't you have to go make trades or something?" I said, "No, I'm bulletproof on. I told you I was already bulletproof on Kraft. I was actually just waiting for the earnings report on Kraft to come out there and see what the results were going to be. And I had two other positions that were near bulletproof. I was not afraid. I didn't
Right.
have to panic adjust. I didn't have to jump in and try to sell, then buy. I didn't have to do anything.
That's marvelous. Well, let's go ahead and talk about why that is, Mike. And what I'm going to do first of all is, as mentioned, we're going to give away the very best parts of the system. If you need more support, it's available. But we are going to try and give away the very best part of not just radioactive trading, but any successful trading system, and that is skewing risk. And let's see here. All right, Mike, I'm going to use an example from about this time last year, and this is Green Mountain Coffee Roasters. And Mike, I got into this position, and you followed me into it, didn't you?
Yeah, I took about half the position, but I did go into the Green Mountain Coffee Roasters trade with you.
Right. What happened was I picked up the stock at $54.20, and at the same time picked up September $65 puts to cover that, okay, for $16.70. Now, the thing that you had told me when I called and asked about searching for in the money puts and far out in time, what had you told me at that point?
Well, I had said that, okay, well, you're buying a put option that's about 15% in the money. You're increasing your cost basis, by 15-20% of what you paid for the stock. So you're going to need the stock to move up at least 20% just to break even. This doesn't seem logical to me.
Right, and but that wasn't really so, was it? For example, if I'm spending $70.90 and the stock goes to $72.10, what would you expect my profit to be?
Well, if you would have told me that if we would have identified this search when we were on our coaching session, I would have told you, look, if that happens, you would have made $1.20. Hey, that's not that great. You could have made much more. I apologize. Excuse me. If you had just bought the stock and let it run.
Right, that's what a lot of folks would believe, and that's almost. I answered an email yesterday where a lady had written in and was saying, well, geez, I don't get it. It seems like your stock has to go up 35% before you begin to make even anything. And honestly, Mike, we're able to do adjustments to where a stock has zero risk and it doesn't have to go anywhere. To where we can pull money out of it by using the income methods, but this is just a starting point. And Mike, if the stock goes to $72.10, you'd think that my profit would be $1.20. How would you like if the profit was actually a little bit more than 9 times as much? Would that be all right?
Yeah, I like that. Absolutely.
Very good. Okay. Now here's the deal. Out of that $16.70 that I'm spending for the put, I'm going to get most of it back. In fact, I'm guaranteed to get most of it back, because down here, if we subtract the cost basis from the strike price of the put, if I exercise those puts, why then the difference is $5.90. That's all I really have at risk in this situation. And another thing to think about is this is April, but then September is when the puts expire. So that's almost 5 months of protection. $5.90 divided by 5 months is $1.18 per month to have this stock protected at such a level that I can't lose more than about 7-8%. Now, Mike, if people were trading on Thursday with an 8% stop loss order, would they have gotten hurt?
Oh, yes. They would have been forced to sell, but with that 650-point drop in a 20-minute period, as soon as the order was triggered to sell, they would have gotten a much worse price than 8% below their cost basis.
Yeah, they would have gotten hurt. And the thing is, Mike, I had control here. I had the ability that at any point I could bail. And honestly, am I going to lose all 8%, all 7%? I forget what this was, 7 or 8%.
It was, I think it was about 7.8% roughly, actually, just a little bit between the two. But no, I mean, you're only going to lose that maximum risk if you hold the position all the way to September expiration and do nothing, or the stock drops more than, let's say, 60 or 70% in the next 2 or 3 weeks.
Okay. Well, here's what did happen. Okay, and I closed this live during a seminar that I was doing out in I think it was Colorado Springs or Monument. It was out in it was in Monument, Colorado, which is near Colorado Springs. With the live audience sitting there, I said, well, okay, today I'm going to close it. And Mike, the stock did go to 72.10. But see, that's not the only thing that had any value. I still own those puts, and the puts still have value. And I sold them for $9.70. Now, you might say, well, geez, Kurt, you lost $7 on the put. Well, let's see if that's so. $16.70 for the puts, and that's what I paid for them.
Right.
And then I sold them for $9.70. So is that a loss?
You lost $7, Kurt. That is a loss. Can't argue that on the put option.
Right. On the other hand, in order for the put to go to $7, the stock had to go up $18. So, Mike, if I took $7 off of your table, but I paid you back $18, would you be okay with that transaction?
Yeah, I think I would be okay with that. I'd let you do that every day of the week and maybe a few times on Sunday as well, sir.
How about 200 times in one day? Would that be okay with you?
Yeah, I think that'd be pretty good.
All right, that's what the market did for me here, and my profit ends up being, okay, the total invested was $70.90 per share, and my total for closing is $81.80 per share, so the profit is $10.90 per share, and then times 200 shares, that's nearly $2,200, okay?
Right.
Now, there was commissions both ways, but you know, it's over $2,000 for an 8-day holding period. Now, Mike, I don't always make 15% gains in 8 days. I also don't always make 30% gains in 2 months, like I did with Marvel. But I do catch those trades. All right, and the reason that I catch those trades is because I'm setting myself up to be in a position to catch them without getting hurt. Okay. We're going to go through five brief little snippets here, Mike. We're going to identify what's the problem with trading stocks and options. We're going to find out why that problem hasn't been solved yet. We're going to find out what's available, what's possible, and then after that, we're going to discuss what's different now and what to do next. Okay? So let's identify what's the problem. What's the problem normally when trading stocks and options?
Well, let's just review back to Thursday. As much as you think you know it's going to happen, as much as you feel safe, and I hate to say this because it does seem unfair to a lot of people, and it does seem, you know, like gambling almost. Really, is that you never know the future. You don't know the future. You don't know what's going to happen, and black swan events do occur, and they're unfortunate, and we see them, and then the exchanges try to make things to change them, but what might the next one be, and when might it come? Could it go in your direction, or could it go opposite in your direction? You don't know the future. And here's a stock chart of I made a lot of money on these stocks. This is XL Maritime, right, Kurt?
Right. During this period of time, I actually traded this stock.
And I made a lot of money with XL Maritime. Eagle Unlimited was another shipper. Dry Ships I made a lot of money with. Dry Ships is a unique one because before I started trading radioactively, it was my most profitable stock that I ever traded, and shortly after that, it was the stock I lost the most money on as well.
Ouch.
Because I didn't know the future. And you can see here, there are plenty of opportunities to maybe make some money, you know, buy at the low points and then wait for the stock to rise. And then, of course, sell down at the bottom or sell at the peaks if you're into shorting stocks or trading bearish positions and then waiting for the stock to retrace and then buy back at a shorter spot. But you just don't know. Whenever it looked like it was in an uptrend, there was a big drop. Whenever it looked like it was in downtrend, there was a big spike. We just don't know the future.
That's right. That's the big problem. Okay, and the solution to the problem is to be able to skew your risk and reward. Mike, I did trade this stock, and I made 10.22% in a 6-week period. Now, it's not the 10.22% that's remarkable. What's remarkable is that I began with a single-digit risk. Then, about 3 weeks into the trade, I made myself bulletproof. I made it to where no matter what the stock did, I could not lose. And so for the remaining 3 weeks that I was in this trade, I was sleeping very, very well at night. And, of course, it did do what I had hoped, and my income method number 3 bulletproofed it. Income method number 5 capitalized, and I took some extra money that I normally would not have taken had I not known income method number 5. And so anyway, that was the end result. Now, Mike, we're not going to be able to share all those income methods today, but we are going to share at least one way to bulletproof your stock. Okay? And but we're going to review the problem. The problem is folks don't consistently profit in the stock market because of not knowing the math that underlies risk management. And that's something that's beyond picking stocks and timing trades. Most folks would think that the single thing that they need to do to improve their trading is to do a better job of picking stocks, or maybe do a better job at timing their trades. I'm going to say that the answer is in neither of those places. And a little bit later on, we're gonna investigate. You can actually be wrong more often than right and still make money. Okay. But here are some attempts at solving the problem. Now, just before we enter that, it sounds like you're real busy answering questions. Are you?
Yeah, I was just having a small conversation with Chris. He apparently had the same experience I did on dry ships and some of the other shippers. We did have an interesting question from Milton, and I answered that a little bit, but Milton just wanted to know, he's very interested in your strategies, Kurt. He's looking to go long on VLO based on technicals. How would you structure this trade? And I told him that, well, Kurt would structure it the same way he structures any trade, just as we saw in the GMCR position. He'd look for put options that match his criteria, match the rules discussed in the blueprint, where he's not risking more than single digits, but also following some other rules that are listed in there as well.
That's right. It's not so much the stock that I would pick. It's the way that I would trade that stock. Okay, and so he wants to know how I'd structure the trade. We'll show him here in just a few moments. Okay, Mike, I've asked a simple question. Are you happy with your last 12 months results trading? And I'm going to leave that pulled up for another 10 seconds, and then we're going to investigate the results. And I appreciate all you guys that are putting in your votes. It's looking kind of grim, isn't it, Mike? Can you see those results as they're coming in?
Yeah, it doesn't look as good as I thought it would be.
Yeah, well, you know, less people mentioned that they own the blueprint this time around. Now, I'm gonna suggest that if you have questions, folks, if you'll hold your questions until there's a certain part that we'll come to where we'll encourage questions. I think that a lot of your questions will be answered by way of the presentation itself, okay? Because we've been doing this a while, and I've learned to anticipate a lot of the questions, and they're in the presentation. The answers to them are in the presentation themselves, okay? But let's discuss these answers here, Mike. We've got 9% saying yes. First of all, I'd like to congratulate that 9%. Good job. You've beaten the market. You've probably beaten your own expectations. That's exciting, okay? Now, let me congratulate the other two groups, okay? The 52% that said no, I'm going to congratulate you because you're in the right place to do something about it. I think, Mike, out of all the stock trading and options trading self-proclaimed gurus that there are out there, I think I'm the only one that does not make any claims as to how much you can make per month. I think I'm the only guy that says you can only lose X amount if you're wrong. And I think that's a good place to start. It's the place to start, is to limit your risk, limit your losses. 39% said mixed emotions. I'm going to congratulate you also for being in the right place to learn how to fix the problem. But, Mike, let's just get this out of the way, okay? What's mixed emotions code for?
Well, that's really code for no, isn't it, Kurt? If we wanted to, if we were happy with our results, we would have said that we were happy with our results, right? And if we, you know, we're really saying that we're not happy, we were not truly happy with results, and you know, we're not poking fun, you know about mixed emotions, don't you, Kurt? You experienced that when you first started trading.
Yeah, nobody's emotions were more mixed than mine than when, you know, I began out making 4% one month, making 6% another month. I thought I was on top of the world, and then losing everything within a matter of minutes from the market open. That was something else.
Yeah, and not to be suggestive, it's interesting that we have 9% of our attendees saying that they are happy with their results. That sort of matches our other number we had from the first poll.
That's right. Let's share that again, okay? What is your involvement with radioactive trading? We have 9% saying that they own the blueprint. We also had 9% saying that they are happy with their trading results. I'm not going to say it's necessarily the same 9%, but we do see a corresponding rise, don't we?
That's right.
When we've had 30% of folks have the blueprint, we've had our happiness rating up in the 20s and 30s. So, all right, Mike, here are some of the attempts at solving the problem. The problem, of course, is that we don't know what's going to happen in the near term. So here are some attempts. One is value picking. That's by some formula or another, going into the market and looking for those stocks that we believe that nobody knows about. Of course, the underlying assumption is that we're smarter than everyone, and not only are we smarter than everyone, but everyone's going to catch up with how smart we are at one point. Is that a lot of assumptions to make?
That's a lot of assumptions, a lot of what-if scenarios that need to play out, isn't it?
That's right. Also, trade timing software. All right, Mike, I am very proud of my record of winning picks. Do you happen to know what it is?
Well, your winning picks, of course, is you always like to say that don't time your trades and trade time. But because you're setting up with a limited risk position, the winners tend to take care of themselves, don't they?
Yeah. You see, I actually win a little less than half of the time. I win a little less than half of the time. But the amount of money that I make when I do win far outweighs the amount of money that I risk. And so my winners are almost double what my losers are. Now, Mike, if you're going to flip a coin, okay, and you lose nickels but you make dimes, are you going to win in the long run?
Yeah, I could play that game, assuming a reasonable probability of around 50%. I would love to play that game.
Okay, so if I were selling trade timing software and I said something along the lines of, hey, I'm accurate 49% of the time, would you be compelled to want to buy that software?
No, that wouldn't sound too attractive to me, honestly, Kurt. I'll be direct with you there. That wouldn't appeal to me too much. Yeah,
it doesn't appeal to many folks, okay? But the thing is, our psychological need to be right. If we can just get past that and just be really, really right when we are, that is the key to success in trading. That is the one quality that I found that all the great traders of the world share. It doesn't matter if they're Warren Buffett, it doesn't matter if they're Jesse Livermore. All of them would do this one thing. They would cut their losers short and let their winners run. Okay, is using a stop order the best way to accomplish that?
Not necessarily, and again, we saw the perfect example of that last week, unfortunately.
That's right. How about diversification? How about just having a lot of different stocks? That'll do the trick, right? Because if you're good at picking them, geez, the 3 that are down, that's counteracted by the 20 that are up, right?
Yeah, but when I have 35 stocks in my portfolio and we have a situation like we had in 2008, I now have 35 down positions.
That's right.
That's not gonna work.
Yeah, when the whole market is down, you just diversify your headaches, and that's not a real good way to go either. Okay, how about this business of selling covered calls? We take a little bit of income, but we hold on to all of the risk of owning a stock. Is that really a wealth option?
Well, no. I'm putting into a positions, and I can make some money. I can generate some income off of a position. But if I entered a stock position thinking it was going to go up and the stock does move up, well, I get called out. I make 5 or 6%. That's great, but the stock went up 15 to 20%. I don't see the rest of those gains. And worse, if I'm doing half diversification and half covered calls, even with stop orders in them, I have 3 positions that move up that give me my 3%, but they still went up 15 to 20%, and I don't see that. And then I have 7 other positions that dropped 5, 10%, maybe 1 position or 2 positions that dropped 20% and violated my stop order. I'm coming out of the month with a very bad loss on my portfolio.
That's right. You see, if it were anything else, if somebody posed the idea to you, hey, I've got 2 investments. One limits my gains, but it gives me a great amount of risk. On the other hand, I've got another investment that has very, very limited risk, and it has unlimited potential. Geez, which of those would you rather go for?
I think that's an obvious question for me. I'm taking the second choice there. I want to see small losses, and I want to be in a position to realize potentially unlimited gains. Of course, we've never found that stock that goes up to infinity, but the key is that also puts me in a position, Kurt, where I can react after the market makes a move instead of trying to react before the market makes a move.
That's right. Absolutely. Well, Mike, here's the one thing about last week that got us in trouble. Okay, the stop order. When I would place a stop order, back when I used to do that, something that I found that was really annoying was this. I found that I had a really accurate way of predicting the future.
Mm-hmm.
And here's what it was. If I bought a stock at 50 and I put my stop order at 47, I just made a prediction. What's the prediction?
Well, you just probably pick the lowest price the stock's going to trade in the next day or two.
That's right. And then I get filled on that stop, and then the stock goes up to 55, 60, 75 points, when I'm out of it. All right, so that's just plain annoying. But this is just plain dangerous, okay?
Mm-hmm.
The fact that a stop does not mean stop at this price and sell, Mike. It's just a market order that becomes active the moment your price is violated.
Mm-hmm.
Here's an example. If for example, on this day, we bought this company, Daktronics, and bought it at 30, if we wanted to protect ourselves to the tune of, say, 10%, where would we place the stop order?
Well, we have a stop placed at $27 per share, 10% below our purchase price of $30.
Okay, so if we got it on this day, see the trading range, if we got it on this day for 30 and we place a $27 stop, we go to bed thinking, hey, everything's fine. This is a top-rated stock. IBD likes it a lot. It's got an A+ rating on fundamentals, A+ rating on technicals. I've got my 10% stop order in place.
Mm-hmm.
And the next day, she opens at $24 a share and goes down from there in high volume. Mike, this is a true happening. This is something that did happen. Would you have gotten a fill at $27?
No, my order would have been triggered now that it's below $27, but I would have sold at maybe $24, $23, maybe even $22 per share.
Yeah, on this particular day, $22.50 is probably what you would have gotten out at. Okay,
Mm-hmm.
and so that's an over 35% overnight loss. On the other hand, if you had bought a put option that was 5, 6, 7 months out in time, let's see, 1, 2, 3. Did we have time enough for this stock to develop in price and come back up?
Absolutely. We were able to hold the position, realizing only a small loss if we had that protection in place. Could have held it for 3 months and then ended up better than where we started for a profit, a decent profit. Or during that time frame, there were several opportunities to do different adjustments with the 10 different income methods to help us lower our break even and lower our maximum risk as well.
That's right. And another thing, too, is, Mike, along the way, if we just got tired of it and discussed it, or just on this day we just said, hey, that's it, I'm out, what would our maximum loss have been if we set this up according to the blueprint?
Probably 5, 6, 7% at most.
That's right. We had Digital River do something like this on me just a few months ago, an over 35% drop, and my loss was 5.7%. How about that?
Mm-hmm.
Okay. Diversification. Here's another idea. If you're good at picking stocks and timing your trades, well, if the whole market is down, again, we've got nothing but headaches. Okay. So, and covered call selling. Mike, let's take a look at this. Okay. Here's your risk graph. This means that we have nearly unlimited risk, and if the stock goes up, we've limited ourselves to having to sell it at a predetermined price, someone else's price. Is that the way to go?
No, not really. I don't like to sell my shares of stock at another price. Now, sure, I know what the common detraction is, Kurt. Well, you're generating 3, 4, 5, 6% per month. Well,
right.
On the positions I'm right on that might have moved up 10, 15, 20% from where I purchased it, I got 3%. That's great. But we used to ask a poll, Kurt, all the time, didn't we? We asked, those of you who were promised 3 to 6% per month using covered calls, do you ever see it? Has your guru proved it to you that he's been able to get it? Have you heard about other people getting it? And we have very low numbers. Never once, right, do we see people who are able to get that on a month-by-month basis. And, of course, as you can see at the bottom side there, Kurt, what happens if we had a stop order during a black swan event, or what happens even if we didn't have a stop order and it was an earnings report worse than a black swan event and our stock was down 25-30%? We keep the losers in our account that are down 25 to 30%, and the stocks we were right on, the winners, get called away for a 3 or 4% gain. Do you think I'm going to make money in the market consistently using that method, Kurt?
No, it's upside down. It's absolutely upside down. Here's a right side up way to go. Okay, let's look at what's possible. Right side up is giving yourself a limited risk, but having unlimited upside opportunity. Here's an example of that. We pick up the stock. We also pick up an in-the-money put option. Here's your total invested amount. This is a live trade that we did during one of these webinars. Okay, and then our guaranteed exit. The difference between what we've put in and what we're guaranteed to get out, that difference is the only amount that's at risk. And when we divide that at-risk amount by what we put in, why then our virtual stop is revealed. Okay, Mike, this is like a stop order, but it's something that I have absolute control over for the period of time that I'm trading in. Is that pretty cool?
Yeah, it's pretty cool. Low risk, right? 4% at risk, 4.5% at risk or so is the most we could lose if and only if the worst case scenario happens over the next 5 months.
Okay, so that's the first thing that's possible, is unlimited profit potential with limited risk. Here's the second thing that's possible. Mike, there's 10 different adjustments that we share in the blueprint. 9 of those adjustments are done at a credit. One of those adjustments, the one that we're going to show today, one of those adjustments is done at a debit, but all of them either take out risk or take in income or both. Okay. What happens when you do sell a covered call? Does it generate some income?
Yes, we're going to collect some income up front, get a little bit of premium there to minimally, I should say, reduce our cost basis. That's true.
Okay, very good. Well, let's say that we're getting into this in May, okay? Let's say in May, well, actually, I guess this would probably be more like April or March that we got into this. I forget, actually. We begin with a risk of 4.4%, then we just sit on it. And then at a certain point, we say, well, okay, you know what? Let's sell the June 35s. Now, Mike, is there some more time between June?
Oh, yeah. Kurt, I think your sound just bugged out. I just lost sound there for a minute or two. So, yeah. I mean,
can you hear me?
Yeah, there we go. Okay, much better. Much better. There we go.
Okay, good. Well, here's the point, okay? If we generate income by doing a covered call, which is only one of 10 ways that I teach, but if we were to do that, this is called income method number 1. All right, if we were to do that, Mike, that 90 cents of income would cancel most of the $1.61 at risk, and then after that, there's more months left to trade. This is one of the ways to become bulletproof. Now, after we did this, we were not bulletproof, were we?
No. We still had about 45% of the risk we initially had entered into there. I mean, we had a 161 at risk. We lowered it by 90 cents, so we still got about 71 cents at risk there.
Right, and it ended up being about 2%. All right, and we did end up making a profit on this particular trade. But bulletproof trading is something that's available. Okay. All right. Now, possibility number 3: when you take those risk amounts down low enough, Mike, it's pretty exceptional what happens, isn't it? Because you can actually be wrong more often than you're right, and still make money. Mike, let's explore that a little bit. Can I turn it over to you for just a minute?
Yeah, go ahead.
Yeah, I'm gonna make you the presenter, and let's take a look at the Trade Simulator tool and explain what that's all about.
All right, hold on one second. Let me just pull that up. There we go. All right, we should be able to see the Trade Simulator tool now up there, and this is available both on Power Options and Radioactive Trading. We'll show you a little bit later how you can access that. And what we're looking at here in the blue box, you see that we have some things set for our target price, and our target price, or our target gain, I should say, is 10%. So let's assume that we're going to grab a coin, Kurt. I'm going to flip it 100 times. When I get heads, I'm going to assume that's a win, and I'm going to make 10%. And if I get tails, well, let me go ahead and assume a loss here of 10% as well. So if I'm going to flip a coin 100 times, I'm going to assume, excuse me, a probability of about 50%, right or wrong.
Let's make those options. I'm sorry. Let's make those options trades just 2.
Okay, yeah, so what we're going to do is simulate having an account of $10,000 and round-trip commission for stock and option, but let's just do 2 instead of 4 there, so we'll cut that down to $34 there instead of 52. Now over here on the right-hand side, this is our results in our yellow box. Now this is a pretty good record there, isn't it, Kurt?
That's a high win record. All right.
Mm-hmm.
I'm going to jot this down. We've got 58 wins, and an ending amount of 21,584.
Mm-hmm.
That's pretty good. Okay.
That's making 10% when we're right and losing 10% when we're wrong there. 58% winners, and took the account up to 26. We had a nail biter there, didn't we, Kurt?
Yeah, the drawback is nights of sleep. You know, when your account is down 33%, you see that low value of 6,700 is not a happy place to be. When your account is down 33%, you know, your spouse is probably saying, "Hey, look, you know, are you sure this is the way to go?" But if you were, you know, perseverant, you stuck through it. It looks like with a record of 58% winners, you would have done okay. Okay, Mike, what if we didn't have such a good record? Let's try it again. Okay,
so we win 10% when we're right, we lose 10% when we're wrong. Oh, there's a little bit better trading record. Look at that.
There's the better one. Let's write down the better one.
Okay.
59 wins. Of course, the low value is lower. The low value is 61.28, so that's an even deeper dip. But the ending amount was 28,574. Great. Folks, this is random every time, so we don't know what's going to happen. We just know that there's going to be a bunch of winners. Can you scroll down there, Mike, a little bit?
Oh, sure.
Show that virtual flipping of the coin. We're virtually flipping a coin, and it wins or loses, subtracts commissions.
Yeah, we're flip-flopping at the beginning, aren't we? A win, a loss, a win, a loss, and then several wins in a row.
Yep. Okay. So, Mike, let's just take a look at that again with if we had more losers than winners.
Yeah, let's see what we can get there. Oh, see, this is more winners than losers, but still pretty disastrous, isn't it?
Yeah. Gosh, we need to have a better performance. Oh, my goodness. Oh, geez. What if we weren't always right with our trading, okay? And we had 45% winning record. Well, we take our $10,000 and we roll it all the way down to 677. That's not good.
No.
Okay. Mike, I've got 2 solutions, okay? Here's the first solution. Let's just always be right.
Okay.
Is that going to work out?
Well, that's not really possible. I mean, sure, you can always want to be right, but that doesn't really give us what we want, is it?
Okay, all right. So that's not a reasonable answer. But let's take our focus out of the yellow box and quit trying to increase our wins. All right, and instead let's go over into the blue box and let's control something that we can control. For example, that win target of 10%. Let's reduce that. Let's actually shoot for a little more modest gain. Is that okay? Let's go for 8%.
Very good.
Okay. All right. And after having done that, let's also look at that loss limit, and let's reduce that down to 4.2%. There's a reason why I'm choosing these numbers. Okay. Now, Mike, let's run that simulation. And holy cow! Wait a minute. I don't understand, Mike. We had a lousy trading record, more losses than wins, and still ended up making money. How is that possible?
Well, it's because that when we lost only 4.2%. But when we won, we made 8%. So again, Kurt, when we're wrong, we're losing nickels, and when we're right, we're almost making dimes, aren't we? Yeah,
let's run that one more time. Let's see if we okay. Now with more wins than losses, we're doing okay here. Mike, let's concentrate on the low value. The low value there is my account is down by 9%. Okay. On the other hand, the high value It looks like we did pretty good. Did we increase our win target? Is that how we came up with these bigger wins?
No, we lowered our win target.
We
dropped
lowered
it
the
down.
win target.
Mm-hmm.
Yeah, and maybe we're able to compound it because we had more left after we did have a loser.
Mm-hmm.
Isn't that something? Mike, here's why I chose the target of 8% and the loss limit of 4.2%. That's my trading record over the last 37 months.
Mm-hmm.
My trading record over the last 37 months, which includes the crash, and is nothing but bullish positions. I wasn't playing bear. I wasn't.
That's right.
I wasn't shorting stock during this time. Mike, my average loss was 4.2. My average win was 8%.
Mm-hmm.
Interesting. Okay, and so that's something that's possible, is to limit your losses. And if you're able to do that, the wins will take care of themselves. Mike, can you pass that presentation back over to me? Let's show folks how to make their positions bulletproof.
All right, there you go, sir. You should be all set.
All right, good. So again, the holy grail of trading involves this. Okay, first of all, limiting your losses to single-digit percents,
Mm-hmm.
and doing it without a stop order, because the stop order is not reliable. It can get you into trouble. While we're leaving our losses at single-digit percents, we want to leave the upside completely open. All right.
Mm-hmm.
And is it possible, Mike, to take income without necessarily selling your stock?
Yeah, of course it is. I mean, we can do different income methods. We can generate income off of that. Sure thing.
What's the most common way to do that? Common way to...
Yeah, I've already discussed it, is just doing covered calls. I think it might be more popular. I mean, another way to do it, of course, is just enter into dividend-paying stocks. But I think covered calls is the most common approach to take income off of stocks.
Right. I was going to say that the very most common is dividends, and the second most common that folks that are involved in options trading do is selling covered calls. Okay, but Mike, we've got 10 different ways to take income.
Mm-hmm.
Okay, and of course we already shared that it's possibly wrong on your picks more often than right and still make money. And of course that's because when we are wrong, we limit our digits. You know what, Mike? Let's just run another poll. Do you remember that poll that we did earlier, where we asked how happy are you with your trading results? And these are the results that we got. Do you see that?
Right. Mm-hmm.
Okay, let's just change one thing. All right, one thing. If you could keep your wins, but your losses were reduced from whatever they were to 6% in any particular trade. I don't mean 6% of your portfolio. I mean just 6% of that particular trade. If you were able to keep your risk down to 6% per individual trade, would you have had a different answer? Mike, this is pretty revealing. Some folks don't know how to answer. Yeah. So we've already discovered the possibility. It's possible to limit our losses down to single-digit percents and still leave the upside open.
Mm-hmm.
It's possible to take income without necessarily selling your stock. It's possible to become bulletproof. Okay, Mike, let's go ahead and close this poll and share the results. I'll give you guys about another 5 seconds to cast your vote. 3, 2, 1. Okay. Interesting. We got round numbers. Look at this. Did you see that up there, Mike?
Oh, interesting. Yeah.
Where before we had 91% say that they were not happy with their trading, now we would have 90% saying either they're happy or they're happier.
Right.
Right? Is 60% happy with their trading? Is that better than 9%?
That is much better than 9%. Mathemagics says that is correct, sir.
Let's put a dollar amount to that, okay? Put a dollar amount on, how much of a difference that would make. Just take a guess how much difference that would make had you been applying this risk-limiting habit. Mike, I a Chris, I think it was Chris K, write in and say that he picked up the blueprint 2 years ago and he never did anything with it.
Yeah, we're talking about that now. It's got a couple people online. Barry's another one who's been looking at the free presentations and information, and last week put him over the edge, and we're just having a little bit of discussion here about what their next process is there to continue forward and to maybe get that updated version there and go from there.
The average radioactive trading client in November of 2008 lost 5 or 6% of their total account. And I think maybe some folks were trading during that period of time. Maybe had a loss that was bigger. Let's go ahead and close this result and share. 17% didn't get it. They didn't understand. And I'm not trying to poke fun. I'm just saying, well, here's why people lock their refrigerator door when they're on a diet. Okay, here's why people have someone to be accountable to. It's because forcing yourself not to risk too much keeps you from losing too much. Does that make sense? So if you didn't see that, come again next week, okay, until you get it. I want to keep you out of trouble. We only had 9% say that they were happy with their trading. We've got twice as many saying, I don't see how that could help. Well, come again, okay, until you do get it.
And we're honest guys. We're honest guys. I just didn't mean to cut you off there, Kurt, but we're honest guys, and we'll admit that, hey, this approach may not appear as sexy as a covered call trade. It may not appear as sexy as a bear call credit spread or a calendar diagonal spread trade, but that's where people get into trouble, because if it looks really sexy, you've got a lot of risk there, and that's what burns you. It's not the fact that you are making maybe 3% or 4% per month, hey, maybe even 5% per month with leveraged spreads. It's what happens on those losses that puts you right back where you started from or worse, and then you have to really struggle to get back.
Yeah. On the other hand, Mike, does 30% in 2 months sound appealing?
Hey, that's more than my personal goals. I'll be honest with you, Kurt. That's way more than my personal goals.
15% in 8 days, does that sound appealing?
Yeah, that's about 5 times my personal goals.
Okay. We'll see. That doesn't always happen for me, but it does happen for me now and again. You see, for my average winning trade to be 8%, some of those trades bring me back 15, 20, 30. Okay.
Right.
But you won't hear that with covered calls, will you? I mean, if you sell a covered call, for example, you're not going to see a 30% gain in your stock. Well, you might see it in the stock, but you're not going to participate. Okay. All right. Let me go ahead and mention 33% would be ahead by 1,000 to 5,000. Another 33% would be ahead by more than 5,000. And 8% would use what the system is designed for, and that is to pick up winners when they're down.
That's right.
And have the money to do it, because your losing stocks didn't lose you too much. Okay. All right, Mike. What's different now when we trade this way? Okay. What is different? Well, here's the deal. First of all, we begin at a place where our risk is limited to a very, very small amount, so we're able to sleep at night. Okay. Secondly, that becomes a platform from which to launch other trades that would normally carry risk but don't. Okay, and then the 10 income methods are used first to reduce risk, then to capture added upside. There's 9 different ways to take money out without adding any risk, and one of the income methods does change the risk structure a little bit, and so we only use it sparingly. Okay, but 9 of those ways will take money out without adding any risk. Is that a pretty cool deal?
Absolutely.
Okay, Mike, just before I share income method number 4, I'm going to ask what kinds of options trading our folks are doing now, so that they'll know, what to look for. We forgot to do this poll, or I forgot to do this poll earlier in the session. Just like to know where folks are coming from, if they're going to really get this.
No, so far this is pretty interesting. I know it's early on, but there we go. Now it's starting to see what we normally see.
Sophisticated audience here today. We're neck and neck with the spread trades and long calls and puts. Neck and neck. Let's give it another 5 seconds. Please cast your vote. This is going to be helpful for us.
This is interesting.
It is interesting. How about them apples? Okay, let me go ahead and share the results. If you didn't get to cast your vote, I apologize. I just want to move along here. 63% are using long calls and puts. That is very interesting. So I would say that a lot of these folks are leveraging themselves. They're using contracts to leverage themselves in the market, which can be good, but it can also bite you, can it, Mike?
And that's true. If I was in long call positions holding a stop loss, I wanted to close it if it drops more than 50%, all of my long calls would have been eradicated on Thursday. However, if I was in long puts and I had to stop in to close them when they gained, hey, I might have made out pretty well if that order could have been filled.
Right, absolutely. Our second place winner is spread trades, and that's good because income method number 4 is a spread trade. Are we ready to show that to him?
I think so. I was just impressed by the fact that this is the first time, this points to that sophisticated audience, this is the first time that people have answered, hey, 38% are doing covered calls, and they realize, oh, well, if I'm doing covered calls, 38% are also probably going to be doing naked puts as well.
Yes, that's right. We normally see the covered callers outweigh the naked putters by 2 to 1 or better, and that's, it's the same trade. A lot of folks don't realize that it has the exact same risk. Okay, Mike, are we looking at the? Can you see the DIA RPM?
Absolutely, the old DIA RPM.
Okay, I like to share this record here because it's my favorite example, although I've done income method number 4 a number of times. In fact, twice in the last month, where within the last 30 days, my return on one of them was 5.7%. My return on another one was 6.9%.
And this is go ahead.
The 6.9% return was in 29 days, so I think that's a little better than, a lot of the covered callers. We were bulletproof, okay? Bulletproof, and then still had a return of 6.9% in 29 days, so pretty exciting.
I used income method number 4 to bulletproof my craft position 2 weeks before earnings, so that's another way. And
you're still in craft, aren't you?
Yeah, oh yes I am. I have the put protection to January 2011. I'm actually a little bit above bulletproof status, about a 0.3 or 0.4% gain, and I've got another dividend coming up in a month or so.
All right, so you're going to get paid while you're owning the stock and you don't have any risk at all. That's pretty exciting. All right, Mike, let's take a look. I picked up DIA at 115, and at the same time the January 07 119 put option. Now, you're a pretty sophisticated options trader, okay, and we've got a bunch of them on the line too. How in the money is this $119 put? How deep in the money is it?
We're 4 points in the money here, Kurt. We've got 4 points of intrinsic value, and we're going to pay $5 total for that put option.
Okay, so therefore, how much of that put option is time value?
Only $1. Our at-risk amount, our time value amount, is going to be $1 of our total investment.
Okay, so we're remembering that it's $1. Now, we're going to take a look at a really interesting phenomenon that I call the ATM bell curve, and I explain very carefully and thoroughly in the blueprint for income method number 3 and 4 and 6, and it's really the strength behind income method 3, 4, and 6. But we're going to show income method 4 right now. Here's how it works. Okay, the stock went from 115 to 120 in 24 days. That's not a very big move, is it?
No, that's less than about a 5% move. That's acceptable. We'd expect to see that. We technically, if we were able to buy on Friday, we saw it on Monday, didn't we?
That's right. Now, Mike, the $119 put option had been priced at $5, but it fell to only $2.05. Now, how much of a loss is that?
Well, you lost $2.95 on the put option. Just as we saw before with GMCR, you had a $5 put option. It's now trading at $2.05. So you lost $2.95 on the put, didn't you, Kurt?
Yes, but for that to happen, the stock had to go up by $5. So, Mike, it's kind of like this. If I borrowed $2.95 from you to buy myself a tall latte, all right, and then I gave you a $5 bill, would you be okay with that?
I think I'd be okay with that. Again, I think I'd let you do that a couple times. I'd be okay giving you $2.95 every time you wanted a latte because you needed exact change, and then you gave me $5 back.
Okay. Now, the market did this to me 100 times, essentially. Now, let's look at something, though. Let's examine something. We looked at how the $119 put option had been priced at $5, but only $1 of it was time value. Now, it's out of the money, right? The stock's at 120, so the 119 put is 100% time value, right?
That's right. Yeah, we have no intrinsic value left. That price is all time premium.
Right, but here's something interesting. Since the price is all time premium, and it happens to be 205, it means that the time value more than doubled, didn't it?
That's right. The time value actually went up while we were in the trade. That's kind of interesting.
Yeah. Now, here's how I take advantage of this phenomenon, and one of the three ways that I take advantage of this phenomenon. Let's take a look here, okay? Mike, what I did was buy to open the January '08 128 put for 970, and at the same time I sold to close the January '07 119 put for 205, right?
Mm-hmm.
Now that created what? A debit or a credit?
You're going to have to pay a debit here. The put option that you purchased is a much higher price than the one you already had that you're selling for just the time premium of 205. So you're paying out 765.
Okay. Now I did pay it out, and I know that I call this an income method. All right. But let's look at what happened. This is the only one of the 10 income methods that's done at a debit.
Mm-hmm.
Okay. But let's look at what the result is. All right. We start out. We do this roll here. This is a one commission trade in my Options Express account. I pay one commission, and I put in 765. Okay, now let's look at the original assets and liabilities. The original investment for the shares is $115 for the stock.
Mm-hmm.
For the put, it's $5 more. So we have a total of 120 invested, right?
Yes, that's right.
Okay. Then I do this income method number 4, and that adds to my outgo, if you will,
Mm-hmm.
another $7.65. So far I've spent how much?
Well, now your total cost is $127.65. The 120 you had in the position plus the new debit of 765 from your roll here, and we've got a total of $127.65.
But yeah, remember my strike price is no longer 119. My strike price of my put is 128. In other words, I'm guaranteed to get $128 out of this position, whether the stock goes up, down, or sideways.
Mm-hmm.
What's my risk?
Well, the new at risk now is actually negative. You're guaranteed to get a profit of at least 35 cents, even if DIA dropped down to $2 per share.
Yeah, if it falls totally out of bed, I'm still going to do it. Let me point something else out. Mike, this is October, and I had purchased a January '07 put,
Mm-hmm.
and I've swapped it for a January '08 put. So now I've got 15 months left in this trade. Is that pretty cool?
That's pretty cool.
Yeah. Did I forget to mention that DIA pays a dividend?
We didn't mention that, and it actually paid a monthly dividend at this time, didn't it?
That's right. Okay. So, Mike, represented by the red circle, this is all the activity that I've shown so far.
Mm-hmm.
The rest of the chart is the length of time that I was able to hold this stock and have it bulletproofed and be receiving dividends. And, Mike, we also know how to do income method number 5 and 6, right?
That's right. Yeah, what are called the money nets, the money net income methods. There, lots of opportunity, and just back on that last page there. Yeah, you would bulletproof the position to 35 cents, but that's just on the downside. You were guaranteed a gain. But had you sold a call yet or done anything else that limited your upside on the position?
Right. If I had sold a call, I'd be obligated to deliver it to somebody else at their price. I couldn't collect the dividend. In fact, in some cases, I might end up owing a dividend if I end up short in my account. So, Mike, here's the deal. We don't have time to share income method 5 and 6, although we have on occasions shared those. What I'm expressing to you is that it's possible to completely bulletproof your holdings and then from there be able to exploit that even further. Mm-hmm. Okay, so we begin at a place where we have very, very limited risk, and I like to say don't pick stocks, pick stops, and by that I do not mean stop orders, do I?
No, not at all.
No, I mean a virtual stop that's guaranteed by a put option.
Absolutely.
Much better. Okay, but more importantly, I like to say don't time trades, trade time. What I did here with income method number 4 was manipulate the time value in the put option
Mm-hmm.
with another put option and make myself completely bulletproof. Okay, and Mike, that's not a unique deal. We do that all the time. I'm going to ask folks out there what what two things impressed you the most today that you learned? And I'm going to ask, maybe what else you'd like to pick up.
Mm-hmm.
Do you like the idea of having single-digit risk but unlimited upside? Do you like the idea that having single-digit risk can develop into you being wrong more often than right, but still making money? By the way, you don't necessarily have to be wrong more often than you're right, do you?
No. If you're a better stock picker, you're gonna have a lot of profits with this methodology, aren't you, Kurt?
That's right. Do you like the idea of bulletproofing, taking your low risk and making it into no risk?
Mm-hmm.
Or do you like adjustments? Now, Mike, we didn't talk about it, but you took a position with a company that fell out of bed.
Mm-hmm.
You bought the stock. You also bought a put option. The stock went down by 75%, returned to a more than 50% loss. Right. But you actually made a profit on that stock. Was that pretty cool?
Yeah. It had taken a couple of months, but that was fine by me. I ended up closing it for around a 1% gain when the stock had been below the 75%. It dropped at one point well below about 75% of my purchase price, and it closed still below 50% of where I bought it, and I could close it for a gain because I'd used the different methods.
Right. That's pretty impressive. Okay. All right, Mike, let me go ahead and share those results, and then we're going to do a final poll and answer any questions. It looks like single-digit risk but unlimited upside is our winner. And then second place is the fact that, hey, you can actually be wrong more often than you're right, but still be making money. Okay? All right, here's the final question. What would you like to know more about next?
Mm-hmm.
And, Mike, we didn't actually share the Power Options, what I call the Search and Destroy platform.
Mm-hmm.
Maybe we can do that on Thursday.
Absolutely, yeah. We'll have our other presentation on Thursday.
Very good. Okay. Mike, I'm going to go ahead and close it right there because we're running low on time. Oh, interesting. It ended up being all multiples of 5 here. Can you see that up there?
Yeah, tell me more about the blueprint, and the Power Options tools are number 1 and number 2, followed by the other free resources. We've got some webinar links and some YouTube videos that you've put together, and then tie there at the bottom for fishing and the next seminar.
Right. We actually have a tie for first, and that is the blueprint and Power Options. So, Mike, let's go ahead and talk about the blueprint. Okay, the blueprint's over 240 pages. It has 8 appendixes, 9 income methods that take cash out, and we just showed one income method. I call it an income method, but we actually add cash, but we make ourselves bulletproof. Okay. The fishing subscription. On the same page, we're going to go to that same page here. You might pick up one of the home study CDs. And here's what's available. Okay, if you want to have your questions answered, you can call this number within the United States or this number from outside. Okay, support at radioactivetrading.com. You can with that phone number. With that email address, you'll get an answer from Mike or myself or one of the radioactive staff or one of the Power Options staff. Okay, and Mike, let me go ahead and take us to here.
All right.
All right. On the products page on Radioactive Trading, that's where you'd find the blueprint, okay? And these CDs are, of course, expansions on chapters of the blueprint. But if you wanted the whole deal, I would say just get the book itself, get the blueprint. We do have a special. Somebody earlier had asked what kind of specials are available with the blueprint. Fission, which is normally $69 a month, will be $10 if you pick up the blueprint today. It's $10 for your first month, and then after that, if you decide you want to hang on to it, it's $69 per month. There's no obligation to take advantage of that right now. You can do it later if you like.
Mm-hmm.
Okay, but that's the special that's going on right now. Fishing is where you get to look over my shoulder and see all the trades that I'm doing. And let's see, Mike, the free stuff. Let's go over to the free stuff here. Resources. On the resources page at Radioactive Trading, this particular link right here will get you into 2 free weeks of power options without an obligation. Okay, there's no credit card. There's no. You just supply us with, or supply them, supply Mike and the gang over there at Power Options with your email address and name, and you'll get a 2-week free trial and all the full support that goes along with that. Also on this page, the trade simulator tool that you saw Mike demonstrating, if you want to play with that at home and evaluate maybe if you're taking too much risk or what kind of risk you'd like to get down to, okay, that would be a real good suggestion. You can pick this up for free, and also a manual how to use it, and the YouTube video that's instructional on how to use it. Okay, Mike, do we have any questions that would benefit the whole gang? We're actually 10 minutes over. I'd like to quit soon.
Yeah, most of the questions, I had that good conversation there with Chris. That was more revolving things on power options, and I told him just as I told anyone else, if you have any, if you're a power options customer, even a trial member, if you have any suggestions on improvement, just go ahead and send them to me. We had that question from Barry on, was it Barry? I apologize, on VLO again, on how he would set it up, and again I just answered that, hey, you know, we followed the details in the blueprint. We'd set it up using a protective put for a limited risk position, and there are rules in the blueprint that are specific, because there is such a thing as taking too little of a risk, isn't there, Kurt?
That's right. Cindy asks, do you use more recent examples in any of your webinars? Cindy, actually we do generally have other examples to use, but I don't necessarily like to keep making new PowerPoint slides. But you can actually take a look at the entire trading record on Fission. Okay, and let me just go ahead and get in there right now.
And hey, there's also, you want to follow Kurt there. If you go to radioactivetrading.com, you'll see a link for the YouTube videos, and he doesn't discuss all of his recent trades, but he has put some videos up there that show the benefits of using this method and having 10 income methods at your disposal on different positions. That research in motion one comes to mind. You had a similar situation I did, where you picked the exact wrong time on a research in motion trade, but you still got out with a profit after a couple adjustments. That's
right. Mike, here are some recent trades. I got out of some trades here recently. I had a 0.9% loss when the rest of the market got 3.4. Had a 5.1% loss when the rest of the market lost 11.4. Had a 1.8% loss when the rest of the market got a 6.3% loss. And then, of course, with Cree Research, you know, in 56 days, 5.7% return, 29 days with Netflix, 6.9% return. So these are recent examples of the same kinds of trades. Okay. Mike, I think that should conclude it. I'm going to thank everybody for coming, and appreciate you all being here. We had more than 5 dozen students in attendance today. I'd like to invite you all to come back next week, and in between now and then,
or Thursday,
pick up the. Yeah. Oh, I'm sorry. Did I say next week? Yeah, Thursday. Very good. Okay, Mike. Thanks for your support and everything, and thank you everyone for coming to the webinar. We'll see you out there.
Okay, sounds great.
Happy trading. Bye for now.